one of the big issues that are threatening the company's viability is inflation. And there's a lot of misinformation about inflation. The Biden administration is contending that, it's the Putin inflationary process and it's due to COVID. And first it was supply chains. And actually, first we weren't supposed to have inflation at all. And if we had inflation, it would last, for 6 months, and that we would see, around 2% inflation in 2022. And I think all those forecasts are gone. So what is it that is driving inflation? I put together this presentation to kind of explain my view on it. And so far, my view has been pretty consistently right. And I wanted to share it with you to help you with your company's decisions. So this first chart, the orange line is total government expenditures, and the blue line is government receipts. And as you can see, there's an enormous gap between the two. And that's what has a lot of economists concerned. That's what has me concerned. And it seems to be of no concern to the Democrats and, the Department of Treasury, Janet Yellen. And it's starting to concern Chairman Powell, the head of the Federal Reserve Open Market Committee. But still, this is what you hear about. And right now we're running around between 8 to 9 trillion in government expenditures. And it's dropped down since the pandemic, but all in all, there's still an upward trajectory. And with Biden's spending proposal and now the war in Ukraine, I'm pretty sure that that's going to keep going up. And on the receipt side, you can see it's running around 4.5 trillion. Now, to put these in perspective, these numbers are from 2020, when we were spending more and revenues were still higher from Trump's economy. Our expenditures are equal to the expenditures of the next 3 countries: China, Germany, and Japan. And our deficit is equal to the deficit of the next 6 countries. You can see that we have some chunky government spending going on, and it's completely outrun the revenues. Why is this important? Well, because our debt to GDP, as you can see here, which is the blue line, has completely spiked and gone into new territory, which is very concerning. Now, the orange line is our government debt, and the gray line is GDP. And as you can see, the government debt has increased tremendously because of government spending and the fact that we're printing money to pay for it. Well, you ask, what does this mean? And it means that we're in some not so welcome company. These aren't the companies that you would say are the examples of the world to the world of disciplined spending and disciplined economic management. We're just below Italy. Lebanon's a little bit further up, but you can see that interest rates are generally tied to the inflation forecast. There's some differences, but the main point is that our standard of living, our ability to remain as the reserve currency for the world is dependent upon our fiscal management. And if we keep spending money and printing money to do it, that's going to hurt us. Looking at this graph, you can see M2, which is the yellow line, and the orange line this time is the GDP. You can see that we are financing our spending by printing money at the Federal Reserve, and then the Treasury is using that to by government debt. Now, you may say, well, why hasn't that caused inflation before? Well, there's several answers to that. I mean, first of all, before, for some reason, this is what's called the velocity of money. And I'm going to talk about that in the next presentation. It's been declining. And so people's spending habits are changing. That's one thing. Another thing is that we've been able to increase production. The increases in money supply have been small enough that we can actually increase production to accommodate the demand. And you can see this in the quantity theory of money. The money supply times the velocity of money is equal to GDP. Now, this has to hold because the velocity of money is actually calculated by dividing money supply by GDP. Why is this important? Because this money supply times velocity is going to determine demand. And in order for the market to work correctly, you need supply to equal demand. So we can further break down GDP into production times prices, right? And if you have money supply running ahead of the ability to increase production, prices have to go up. I'll just finish by saying that government spending is a huge problem. And you're not going to get rid of this problem by spending more, because it is the source of the problem. And I'm going to talk about that in my next videos. Talk about Biden's contention or statement that 17 Nobel Prize winning economists are supporting his Build Back Better program, and looking at some of the other statements that he has made that aren't true. But the big thing driving the demand right now in this country is the increase in money supply, and it's continuing to grow at 12%. And based on that formula, we should continue to expect to see inflation between 8 to 10% for the rest of this year. So you need to factor this into your business decisions, because inflation isn't going away. If you like this material, subscribe to my channel and send me comments. Let me know. Follow me on Facebook and on Twitter.